Hello, this is Jessica, and we are going to be working through Chapter 7 about equity valuation today. There are some primary differences between debt and equity. Debt is concerned with borrowing. It includes all borrowing by the firm. That includes bonds. Remember, we talked about how bonds are debt instruments. And the requirement for debt is that it is repaid according to a fixed payment schedule. So the interest and the principal payments are due according to contractual terms over fixed periods, and will be paid off at some point. Equity are funds that are provided by the firm's owners, and there is no strict repayment schedule. Those owners only receive compensation according to firm performance. So when the company does well, the owners will receive compensation in the form of dividends and in the form of stock price appreciation. There's some key points here, just some terminology. Debt financing is obtained from creditors, while equity financing is obtained from investors. Um, so just some terminology to be aware of. Creditors, those that provided debt, they do have a legal right to be repaid. So it's in the contractual terms. If the company does not repay the creditors, then those creditors, according to their contractual terms, may have some recourse. They may be able to sue the company. They may be able to seize assets. Investors don't have any contractual right to be repaid. They only have an expectation. So they have invested money in the company. There is a large potential upside because remember when we talked about the income statement, the earnings available for common shareholders is the very bottom. So they are exposed to the most risk, and therefore they also have the most upside potential. They only have an expectation of being repaid. There's nothing contractual that says these equity holders must receive any form of compensation. And so here I have a chart, and I'm going to go through each one of these and explain them in detail. Um, but the key differences between debt and equity are that equity holders have a voice in management while debt holders don't. The claims on assets and income for debt holders are senior to equity holders. Debt holders do have a stated maturity, so at some point they will be paid off and they will no longer be debt holders. Equity holders are there forever. They've contributed money, they're owners of the company. And with debt, the interest paid on that debt is tax deductible. But for equity holders, there's no such benefit. So even the dividends paid to the equity holders, there's no tax benefit there for that. So unlike creditors, equity holders are the owners of the company. Stockholders usually have voting rights that allow them to elect board members and allow them to vote on special issues, such as a, a merger or an acquisition, um, anything that requires a vote from the shareholders. Within the charter and bylaws of each company, there are certain provisions set up that say for this action to happen, we have to have a vote from the shareholders. And sometimes it even requires a supermajority vote. And so this is going to be different from company to company. But debt holders, they don't have this ability to vote. They don't have voting privileges. Instead, they have contractual provisions. So within their debt agreement, they are going to use that to be their voice in management. It's going to give them some power within the company because it's going to place legal obligations on that company. So, for example, within a debt agreement, there may be a restriction that says that the company cannot pay excess dividends to their current shareholders or can't pay excess compensation to their executives or that the company can't sell specific assets. So this is the control that the debt holders have within the company because they don't have the power to elect for the board members. Equity claims on income and assets are secondary to the creditors. So when we look at the income statement, we see that the 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 shareholders, the earnings available to common shareholders is the last line on the income statement. So that means that they're paid last. That also means that they're exposed to the greatest risk. And one thing that we've learned in this class is that more risk equals greater return. And so they should expect to see the greatest returns, but that's not guaranteed. And the claims on the income cannot be paid to the equity holders before the creditors are satisfied. So the company is going to have to pay their debt obligations before they pay their equity holders any dividends. So what about bankruptcy? Whenever we talk about the timing of cash paid to equity holders and debt holders, we see that within bankruptcy, secured creditors are paid first. And so secured creditors, these are creditors who have a claim on assets. So that's what secured means. It means that there is some sort of collateral there. So if you think about the loan that you have on your car, the bank that gave you that money has a claim on that car. That's their secure. That's the collateral for the loan. In the event that you don't pay that car loan, they're going to take the car back. So in the same way for businesses, there are secured creditors, and these creditors have claims on assets. It could be rolling stock like your car, or it could be fixed assets. Maybe they finance the building that their offices are housed in. If they don't make that monthly payment as contractually promised, then the creditors can seize that asset. Unsecured creditors have no claim on assets. They only have a promise to be repaid. So this is akin to your credit card. If you have a credit card and you have a balance on it and you choose not to pay that, that credit card company can't come and take anything that you have. All you've given them is a promise that you're going to repay. You haven't pledged that with any assets. So in the event that you do not pay, cannot pay, choose not to pay, they can't come and take your stuff. The only thing they can do is ruin your credit score. So unsecured have no claim on assets. Unsecured credit can come from banks, bonds. It can come from suppliers, customers. And if you think about things like trade credit is a great example of unsecured credit. The bread man comes and delivers your bread for the week if you're a restaurant, and they give you until the next week to pay for that bread. They have no claim on any assets. What are they going to do? Come take week-old bread? The only thing that power they have is to say that, okay, well, I'm not leaving you any additional bread until you paid last week's bread bill. So unsecured creditors, they only have the promise to be repaid. They don't have any claims on assets. Equity holders have the final claim on assets. So after the secured creditors have been paid, they're first in line. Second in line would be unsecured creditors, and at the very, very bottom are equity holders. Equity holders have the very last claim on assets, and they may not receive anything if the company is facing financial troubles. But at the same time, if you are an equity holder in a very successful business and you think about, well, the secured creditors have been paid, the unsecured creditors have been paid, we paid all of our taxes, all of our payroll, and we still have a humongous sum of money left at the end of the day. Good news is that belongs to the equity holder, so they have huge upside potential as well. Equity capital is a permanent form of financing, so it doesn't expire. There is no maturity date. Once you've purchased stock in a company or invested money in a company and become an equity holder, then you are going to be that equity holder until you sell it. So equity has no maturity date and never has to be repaid. Debt, we've talked about debt, and we have done some loan amortizations, and we see that with debt, there is a point in time at which that debt has been repaid. And once that debt has been repaid, that debt holder is no longer, that creditor is no longer a creditor. They've been repaid everything that they've given. And one of the biggest differences between debt and equity is the tax treatment of distributions. With debt, that creditor is going to receive interest and principal payments each month, and at some point it will be paid off. The interest paid on that loan is tax deductible. Dividends, however, are not. So when you're talking about equity holders don't receive interest payments. The only cash that equity holders are receiving are dividend payments. Those dividend payments are not tax deductible. So because interest is tax deductible and dividends aren't, then the interest makes debt a cheaper source of financing. So to repeat that, the tax deductibility of interest makes debt a cheaper source of financing than equity. Common stockholders are not the only equity holders. There can also be preferred shareholders. Remember we talked about before how most preferred stock is held by founding families. It's held by other corporations. But common stockholders are often referred to as the residual owners and are the true owners of the firm. As residual owners, common shareholders receive whatever's left over. They are assured of only one thing. They can't lose more than they put in. And so because of that, because they're in this uncertain position, they have the potential to lose everything they put in, although there is some protection because this is a corporation. Remember we talked about corporations have limited liability. Then they should also have very high returns on average. Common stock can be privately owned, closely owned, or publicly owned. And so the differences here, privately owned means that it is owned by private investors. So these shares are generally for very small corporations. They're usually not traded. And if those shares are traded, the transactions usually require firm consent. So you think about a very, very small corporation. Maybe it's family held. There are a couple families involved. If one family wants out, they're going to have to get permission from the other families on who that they can sell to. Closely owned, this is companies that are owned by a small group of investors. These are going to be slightly less restrictive than the privately owned companies. They may still require some permission, but they're generally not publicly traded. Large corporations are publicly traded. They're publicly owned, and their shares are generally traded on the stock markets. There's a few more things that we need to talk about concerning common stock and some definitions, some vocabulary before we get into the valuation. So some of the key aspects here, the par value of common stock, you may have heard of this before, and it's listed on the balance sheet, but it is an arbitrary number. So the par value has no real meaning. Par values are generally quite low. They're usually less than $1 because corporate taxes may be determined by the par value of stock, and some states have laws against selling stock below par value. So the par value is established for legal purposes during the firm's corporate charter. And the primary reason it's there is because it allows you to find the number of shares of stock outstanding. Because the par value doesn't change over time. It has been static since the company was founded, since the company's charter. When a firm sells new shares of common stock, the sale of that stock is going to be recorded on two separate lines within the balance sheet. So the par value is going to be recorded in one line, and the amount in which the stock was sold above its par value is recorded on a second line. A preemptive right allows stockholders to maintain their proportionate ownership when new shares are issued. This protects them from dilution. So dilution is when the company issues additional shares of stock and the existing owners' fractional ownership becomes smaller. So their piece of the pie becomes smaller because all of a sudden the company has sliced the pie into more pieces. So there's additional shares of stock that are issued, so the fractional ownership becomes a little bit smaller. To combat that, there are preemptive rights that allow you to put in more money to protect your fractional ownership. So if you still want to own the same percentage of the company, you can purchase an additional stock or put up more money, a preemptive right, to maintain that ownership. Dilution of earnings is a result from the dilution of ownership. So whenever your stake on the company becomes a little bit smaller, your claim on earnings also becomes a bit smaller. And so dilution of earnings is the reduction in each previous shareholder's fractional claim of the company's earnings. So when a company issues a new stock, your ownership stake becomes a little bit smaller, and therefore your claim on earnings becomes a little bit smaller. Rights allow stockholders to purchase additional shares at a price below market. They can purchase these in direct proportion to the number of shares they currently owned. Rights are important because without rights, shareholders would lose their proportionate control of the corporation. So the company needs more money to grow. They can sell additional shares of stock, or they can allow the existing stockholders to purchase additional shares below current market prices, which is good for the shareholder because now they maintain their ownership in the company. And it's good for the company because they were able to raise this capital without having to go through a seasoned equity offering, without having to advertise and spend tons of money on that. So authorized shares are the shares of common stock that a firm's charter allows it to issue. Firms generally authorize more shares than they intend to issue to keep from having to amend the charter, because anytime the charter is amended, it usually requires a supermajority vote of shareholders. And so that's costly to do. Outstanding shares are authorized shares that have been issued. So these are issued shares of common stock that are held by investors. Treasury stock is issued shares of common stock that's held by the company. So the company may have repurchased shares in the open market and they're holding on to them. That would be treasury stock. Issued shares are the number of shares of common stock that have been put into circulation. So issued shares is the combination of outstanding shares and treasury stock. So it's all stock that's been issued, whether it's held by the company or held by investors. And so here we see this, we see that the example of par value here. So this company has a par value of 80 cents. Whenever this stock was sold, it was sold for more than 80 cents. But only 80 cents of the sale price is recorded on the common stock par value. The paid-in capital in excess of par contains the remainder of the cash received in excess of par. So let's suppose that this stock sold for $2. 80 cents would be recorded on the first line. $1.20 would be recorded on the second line. And the importance of this is that the par value doesn't change over time. The par value is set. It was set in the charter. It's not changing. But your stock price does. Your stock price is continually changing. It's changing 1,000 times a day. More than that. But anyway, your stock price is continually moving. And so if you were to record each time that you sold that stock each time you had a public offering, and each time you sold stock, you're selling that at a different price than you did the previous time. So you need to make sure that you're recording that 80-cent portion by itself, because that hasn't changed, and it allows you to determine the number of shares outstanding. Usually each share of stock entitles every shareholder to 1 vote per share, and these votes are cast at the annual meeting. Now, that doesn't mean that the shareholders have to be at the annual meeting. They can give those votes to management to vote for them. They can be assigned. They can also vote via the internet, phone, mail. But a proxy statement is a statement that allows a shareholder to transfer their vote to someone else. Most stockholders don't attend the annual meeting, so they can sign their proxy statement giving their vote to another party. Usually, the group that issues the proxy statement is management, and that's because they are able to use company resources, postage, printing, office staff, to mail these out, to distribute them. And so existing management usually receives the stockholders' proxies because they're able to do that at company expense. So it gives the existing managers the ability to vote on behalf of other stockholders. A proxy battle is when a non-management group tries to gain control of the company by soliciting proxy votes. So they're out there trying to get these proxy votes instead of management. This is very costly because they're no longer able to use company stamps, company office, company paper, printing. They're having to fund this themselves. Super voting shares are shares of stock that have multiple votes per share rather than a single vote per share. And so this is what we refer to as multiple classes of stock. So when a company has multiple classes of stock, then usually one class will have super voting rights. So for example, let's say a company started out as a privately held corporation. They grow tremendously and they need access to more capital, and so they decide to become publicly traded. Those existing shareholders, they're going to want to retain control. Those shareholders that were there in the beginning days when it was a privately held corporation, they want to retain control. And so when they take that company public, they may call the shares of stock that they currently own Class B shares, and the shares of stock that they're going to sell as Class A shares. Those Class B shares that are held by those founding investors, they may give themselves 100 votes per share. But the new shares that they're issuing, those get 1 vote per share. That allows them to have majority voting power to still steer the direction of the company. There can also be non-voting stock. Non-voting common stock has no voting rights, and this happens when a company wants to raise capital, but they don't want to give up any voting control. Dividend payments are at the discretion of the board of directors. Dividends can be paid in cash, stock, or merchandise. Dividends are not promised, but they do come to expect them. So we call dividends sticky. And what we mean by this is that once a company declares dividends and starts paying them, investors expect them to continue. And if you think about what type of investor you are, it might make more sense. So if you're young and you're in your earning years, a dividend paying stock is a bit of a hassle because you get this cash every quarter and you have to decide, what am I going to do with this? I don't need it right now. But let's look at the flip side. Let's consider you in retirement age. When you're in retirement age, that quarterly check is really nice. So when you're older, you may want a dividend paying stock, and while you're younger, you may not. So dividend paying stock is going to attract a specific clientele. The international market for common stock is not as large as for international debt. Disclosure and reporting requirements from the SEC have historically discouraged all but the largest of foreign firms from directly listing shares on the New York Stock Exchange or Amex. Um, but cross border issuance and trading of common stock has dramatically increased during the past 30 years. The benefits is that it allows the company to broaden their ownership base and can help integrate themselves in the local business environment. American Depository Receipts, ADRs, are dollar denominated receipts for the stocks of foreign companies that are held by a U.S. financial institution overseas. American Depository Shares, ADSs, are securities backed by ADRs that allow U.S. investors to hold shares of non-U.S. companies and trade them in U.S. markets. So ADSs are issued in dollars to U.S. investors and are subject to U.S. security laws. And they give investors the ability to diversify their portfolios internationally. We've talked about preferred stock a little bit. Preferred stock is senior to common stock. So that means that in the event of bankruptcy, they will receive payments first. Also, whenever we're talking about dividend distributions, preferred shareholders have a promised dividend, and their promised dividend is paid before the common shareholders. Preferred stock dividends can be stated in a percentage or dollar amount. Par value preferred stock is preferred stock that has a dividend percentage associated with it. So you use that percentage to calculate the annual dollar dividend. So for example, if we have a par value stock, the par value is $100 and it has a 10% dividend, then the dividend would be $10. It would be 10% times 100. No par preferred stock is preferred stock that has no stated face value. Instead, it has an annual stated dollar dividend. So instead of the dividend being stated in percentage term, it's stated in dollar terms. We often consider preferred stock quasi-debt, and so we say it has debt-like features. Preferred shareholders are owners of the company, but because they are promised a dividend, we say that it has debt-like features. So it does specify a fixed periodic payment. Preferred stock is unlike debt in that it has no maturity date. They are owners of the firm. And because they are senior to common stockholders, preferred shareholders are exposed to less risk. Preferred shareholders are not normally given a voting right, however. They are sometimes allowed to elect one board member. Restrictive covenants are rules that prohibit the company from selling senior securities, participating in mergers, prohibit them from selling assets, require minimum liquidity requirements, and limit repurchases of common stock. Preferred stock can be cumulative or non-cumulative. Cumulative means that the dividend that is promised to the preferred shareholders must be paid, even those in arrears must be paid before common shareholders. So preferred shareholders are promised the dividend is not contractual, so if the company doesn't have the money, they can skip that dividend. But if the preferred stock is cumulative, then all of those missed dividend payments have to be made before common shareholders can receive anything. Non-cumulative preferred stock is preferred stock where the dividends do not accumulate. So if a dividend payment is missed, then it's forgotten about. It doesn't have to be made up. Callable feature, this allows preferred stock to be retired within a certain period of time at a specific price. A conversion feature allows preferred stock to be converted into shares of common stock. So how do we issue common stock? If you're a company, how do you become publicly traded? Initial financing for a company usually comes from the founding family. So they usually make a capital contribution. They're considered equity holders. Um, but usually these early stage investors run out of money and need additional capital. So initial non-founder financing. So the founding family will contribute money to the company. You start something in your basement, you're going to fund it as much as you can, possibly using, home equity lines of credit, your credit card, any cash you have piled up. You then go out to your friends and family and you say, hey, look, I got this idea. It's working. Can you contribute some cash? Those are your original founders in the company. At some point, you're going to exhaust their resources and you're going to look for non-founder financing. And this usually comes from private equity investors. Once a company establishes itself, they will often go public by issuing shares of stock to a much broader group. So how do we get that initial private equity investment? So we've exhausted all of our friends and family and we're looking to grow. We need some more capital. We're not quite ready to go public. What is that interim step? That's where venture capital comes in. Venture capital is privately raised external equity capital, so ownership. They're contributing money in the form of equity, so it doesn't have to be repaid. That is typically used to fund early stage firms. Those that grant the venture capital are called venture capitalists. Venture capitalists are usually formal businesses. They do maintain oversight in the firms they invest in, and the main key is that they have clearly defined exit strategies. So the defined exit strategies, they only have a few ways to exit the company. Those founding family could purchase them, buy them back out. The company could be bought out, or they could go public. But they're going to have a defined exit strategy because that venture capitalist, they're not going to make any money until that company does liquidate. And so with a privately held company, it's often difficult to liquidate your ownership position. So the venture capitalists, their only exit plans are for the founding family to buy them out, for another company to purchase the entire company, or for them to go public. An angel capitalist, this is a wealthy individual investor. They don't operate as a business, but they do invest in promising early stage companies in exchange for a portion of the firm's equity. So I'm sure you guys have seen Shark Tank. This is a great example of people investing in early stage companies. They are maintaining great oversight in the company, and they are requiring it is a negotiation. So they are giving large sums of money, but in exchange for that money, they are taking a large portion of ownership. So here's a table showing the organization of institutional venture capital investors. Usually venture capitalists are organized as limited partnerships. This allows them to bring on partners. So let's say you had some extra money and you wanted to invest in early stage companies. You could join a venture capitalist limited partnership. This would allow you to be a limited partner. You could invest money in that company, but you would have limited liability. There does have to be one full partner, however. That full partner is the decision maker. They're the ones that are actively searching for these companies and making investment decisions. Venture capitalist limited partnerships are the most common. 40 to 50% of their capital is usually devoted to startups. Another 40 to 50% of capital is devoted to later stage companies for expansion and marketing, and then 10% is buyout and acquisition of other companies. Venture capital investments are made under legal contracts, so there is some legal recourse. They are going to clearly define the responsibilities and ownership between the existing founders and the venture capitalist fund. The terms are going to be negotiated, but they're going to be dependent upon the original founders, the business structure, the stage of development, and other market and timing issues. Specific financial terms, also to be negotiated, depend upon the value of the company, which is very subjective, the amount of funding required, and the perceived risk of the investment. To control the risk of the venture capitalists, there can be covenants put into the contractual agreements. So they may have specific rules the company has to follow. The funding may be staggered. So they may say, okay, well, we're going to make an investment of $1 million in your company. We'll give you $250,000 once you meet this hurdle. We'll give you an additional $250,000 once you meet this hurdle. And they may stagger the funding dependent upon performance. The contract will also have a clearly defined exit strategy. So the amount of equity that the venture capitalist is going to get is a negotiation, and it depends upon the value of the firm, the terms of the contract, what are the exit terms, and what is the return that the venture capitalist requires on their investment. The most favorite way for a venture capitalist to exit a company is through a public offering, because that grants them the greatest return. It's not the only way they can exit, but it is their most preferred way. So if a company does decide to go public and they do want to sell their company in the primary market, they have three alternatives. First is a public offering. This offers shares of stock to the general public. So this is when we see publicly traded companies issuing stock and they're trading on major stock exchanges. A rights offering. This is where new shares of stock are sold to existing shareholders. And third, a private placement. This is where the company sells new securities directly to an investor or a group of investors. We're going to focus on the initial public offering. This is the first public sale of the firm's stock. IPOs, initial public offerings, are typically made by small, fast-growing companies that need additional capital, or the venture capitalist is requiring them to go public according to their venture capitalist funding contract. The firm does have to get approval from the existing shareholders, and they have to hire an investment bank to underwrite the offering. The investment bank is going to have the responsibility to promote the shares of stock and to facilitate the sale of the company's shares. They're going to help the company set the price and to gauge demand. So once they've hired an investment banker, they do have to file a registration statement with the SEC. The prospectus is the portion of the statement that describes the key aspects of the issue, the issuer, and its management and financial position. A preliminary prospectus is called a red herring. So once you've filed a registration statement with the SEC, there is a waiting time between the filing of the registration statement and the approval, and during that time it's called a preliminary prospectus or a red herring. And it's called a red herring because it looks like this. It has red text across the top. Once the SEC has approved the registration statements, the company must observe a quiet period, so company officials are restricted on what they may say about the company. The purpose is to make sure that all potential investors have access to the same information about the company. Investment bankers and company officials are going to promote the company, so they're going to go around and advertise. They go on a road show, which is a series of presentations to potential investors across the country and sometimes overseas. This helps them to gauge demand and to set the initial offer price. After the underwriter sets the terms, the investment bank sets the terms, the SEC approves the offering. So the investment banker, this is the financial intermediary that specializes in selling new security issues and advising firms. So remember we talked about the difference between investment banks and commercial banks, and we said that commercial banks accept deposits and make loans. Investment banks do not accept deposits. They make their money through fees, through assisting companies in selling new securities and making advisings, assisting with mergers and acquisitions. So they they make their money through charging fees, usually in an advising capacity. Underwriting is the role of an investment banker. They bear the risk of selling the securities purchased from the company at an agreed on price. So the investment bank that underwrites the security purchases this security from the initial company. They then resell that stock at a profit to the broad market. Sometimes, however, an issue is so large that one investment bank can't handle all of the risk by themselves. And so if that happens, they create an underwriting syndicate. So this is a group of bankers that is formed by the initial investment banker to share the risk with underwriting new securities. This syndicate is going to share the risk. They're going to together purchase all of the shares from the company, and together they're going to participate in reselling those shares to the public. The selling group assists with the selling of the new securities, and it's brokerage firms that join together, and they accept responsibility for selling shares on a commission basis. So here is a picture of this graphically. So we have the issuing company. They hire an investment banker. If it's large enough and that investment banker can't handle the issue on their own, they may partner with other investment banks to create an underwriting syndicate. They then form a selling group, which has the responsibility of selling this stock. So here's an example of how the investment bank is going to make money. Usually, compensation comes in the form of purchasing the stock from the issuing company at a price below market. So, for example, an investment bank may find that a company stock is worth $26 per share. So they pay the company $24. So that way they have a $2 spread there to make a profit. The investment bank will sell these shares to the selling group for $25.25. So the investment banker then earns $1.25 per share, and the selling group is earning 75 cents per share. Common stockholders, we're going to work on valuing common stock, and to do that, we need to talk about a few more aspects. But common stockholders usually receive compensation in the form of dividends or through stock price appreciation. And so how do investors decide what to buy and sell? We already talked about how some investors are attracted to dividend-paying stock and some aren't. But their goal is to maintain a diversified portfolio. Other investors may have a speculative motive for trading. They may try to find stocks that are undervalued and then sell them for more when the market swings, which is much more speculative. Economically rational buyers and sellers use their assessment of risk to determine the stock's value. In a competitive market where there are lots of participants, so there's lots of buyers and sellers, there is going to be an equilibrium price, which is the market value for each security. And because information is constantly flowing, stock prices are going to be constantly fluctuating. They're going to be continuously moving toward a new equilibrium that reflects the most recent information available, and this is known as market efficiency. The efficient markets hypothesis is a theory that describes the behavior of a market where securities are in equilibrium. Security prices reflect all available information and react swiftly to new information. And there's not a lot of need to find mispriced securities because stocks are fully and fairly priced. Not all investors believe that the market is efficient. Some feel that it is worthwhile to search for undervalued or overvalued securities and trade them for profit or to look for inefficiencies. There are also lucky investors who are able to anticipate and use new information better than others. But it's unclear as to whether success is the result of superior ability or market inefficiency. Considerable evidence supports the concept of market efficiency, that information is widely disseminated, it's immediately incorporated into stock prices. But there has been a growing body called behavioral finance that does cast doubt on the validity of this notion. So, behavioral finance looks at how our psychology, our behavior affects our financial actions. And we see lots of really interesting things that have emerged from this. First up, regret theory. Regret theory says that we have a very strong reaction to poor decisions. So we have a very large emotional reaction when we realize we've made a bad decision, and that regret is sometimes greater than the benefit we see when we make a good decision. Hurting. Everyone else is doing it, so I'm going to do it too. Everyone else buy our stocks because that's what everyone else is doing. Mental compartments. We have a tendency to place particular events into different mental compartments, and the difference between these compartments sometimes impacts behavior more than the events themselves. So, for example, a survey was conducted that asked individuals if they would purchase a $20 movie ticket if you got to the theater and realized that you had lost a $20 bill on the way. So you had already purchased a $20 movie ticket, but once you got to the theater, you realized you lost a $20 bill, fell out of your pocket. 88% said yes. They asked the same question to the same group of people and said, would you purchase a $20 ticket if you got to the theater and remembered that you had pre-purchased a $20 ticket that you forgot at home? So would you pay $20 for a movie ticket if after you got there you realized you left a prepaid $20 ticket at home? Only 40% said they would. It was the same effect. Either way, you lost $20. But in one circumstance, you went to the movies, and the other, you didn't. Prospect theory. This says that we have a different degree of emotion towards gains and losses. Losses hurt more than wins. So losses hurt us more than wins help us. Anchoring is the tendency of investors to place more value on recent information. And so now we're ready to value common stock. And so here's our basic stock value equation. We know that common shareholders are going to receive compensation in the form of dividends and stock price appreciation. But stock price appreciation is just a reflection of future earnings, which should be future dividends. So we could say that the value of the stock today is equal to the present value of all future dividends. So we can use a couple of different models. First up, let's look at the Gordon model. Or the constant growth model. They're the same thing. The constant growth model or the Gordon model says that we can value common stock if dividends are going to grow at a constant rate. So as long as dividends are growing at a constant rate, whether that's negative, zero, or positive, it doesn't matter. We can use this formula. And it says that the price of the stock today, I'm looking at the bottom line here, the price of the stock today is equal to the next dividend you would receive divided by R minus G, the required return minus the growth rate. So with this, when we think about stocks and we think about what is the value of the stock today, if it's a reflection of all future dividends, then we can represent those dividends with D's. So the D sub T here, the dividend at time period, whatever, that is telling us what the dividend is at a specific time period. So D sub 1, a D with a little 1, would be the dividend in one period. D sub 2 would be the dividend in 2 time periods from now. We always assume that D naught has been paid. So always assume D naught has been paid. So D1 is the next dividend payable. So the Gordon model says that the price today is equal to the next dividend divided by the required return minus the growth rate. We can also have, so growth rates can be positive, negative, or zero. And this Gordon model works as long as it's constant. If the growth rate were zero, we would just plug in a 0 for G, and we would have this formula. The price today is equal to the next dividend divided by the required return, which is a perpetuity. Remember we talked about the present value of a perpetuity? It was cash flow divided by rate. This is the example of that. But you don't have to remember this equation. If it does have a 0 growth rate, plug in a 0 in the Gordon model, and that gives you that 0 growth rate model equation. So let's just jump in and do an example. Chuck wants to estimate the value of a company. It's expected to pay a $3 dividend, and that dividend is remaining constant forever. His required return is 15%. So the Gordon model says that the price today is equal to the next dividend received divided by the required return minus the growth rate. So with that, this company is expected to pay $3 per share forever. So the dividend's not growing. The dividend today is $3, the dividend tomorrow is $3, the dividend in 5 years is $3. So from that remaining constant statement, we can say that the growth rate is 0. So the price today would be equal to the next dividend you receive, which the dividend's not growing, so that's still $3. If you wanted to calculate that mathematically, the formula is the dividend today is equal to the last dividend received times 1 plus the growth rate. So here the last dividend received was $3, and the growth rate is 0%, so that's still $3. So the next dividend you receive would be $3. Divide that by our required return minus our growth rate of 0. $3 divided by 15% is $20. So the value of this stock is $20. Lamar Company, they have paid these historic dividends, which this is something that you often see. When you're trying to value a stock, you may not know what the growth rate and dividends are, but you may be able to find historic dividends, and you can calculate the growth rate in those historic dividends and assume that that's going to occur in the future. So here we're assuming that historical growth is an estimate of future growth. So if we calculate the growth in dividends over 7 years from $1 to $1.40, that tells us the growth rate is 7%. I'm not going to ask you to do that on an exam. So we see that the last dividend paid was $1.40. So here, if you wanted to keep the same annotations that we've been looking at, D naught is always the last dividend paid. So D naught is $1.40. We see that the growth rate is 7%. And let's assume, this would be given to you in the problem, that the required return is 15%. So the Gordon model says that the price today is equal to the next dividend. I wrote that backwards, excuse me. The Gordon model says that the price today is equal to the next dividend you would receive divided by R minus G. If you don't know the next dividend you would receive, we can calculate that. So D1 is equal to D0 times 1 plus the growth rate. So here in this instance, we know the last dividend paid, but we don't know the next dividend paid. But if we're assuming that dividends are going to continue on this track of growing at 7%, then we can calculate D1. Our last dividend paid was $1.40. Let's multiply that by 1 plus 7%, and we get $1.50. So our next dividend paid is $1.50 if the dividends continue to grow at 7%. So plugging that into our Gordon model, which says the price today is equal to the next dividend of $1.50 divided by the required return of 15% minus the growth rate of 7. So that's $1.50 divided by 8%, and I got $18.75 per share. So let's do another example. Let's suppose a company just paid a dividend of $2. Dividends are expected to decrease 5% a year forever. The required return is 10%. So notice that this is a decrease. So our growth rate is a negative 5%. We're still using the same formula because this decrease is constant forever. So the Gordon model satisfies because we're having a constant growth rate dividend. So the Gordon model says the price today is equal to the next dividend you would receive divided by R minus G. But we don't know what D1 is. We know what D0 is. We know that D0 is $2. We know that D0 is $2, and we know that because it says the company just paid. So it's already been paid. So D0 is $2. So to calculate dividend 1, it's D0 times 1 plus the growth rate, which is $2 times 1 minus or plus a negative 5%. So here, let's see. $2 times 1 minus 5%, 95%, $1.90. So our next dividend we receive is $1.90. So now let's go back over to our Gordon model. Our price today is equal to that $1.90 divided by our required return of 10% minus a negative 5%. And remember that subtracting a negative is the same thing as adding a positive. So that's $1.90 divided by 15. So divide that by 15%. And we get $12.67. Okay, so let's try one more example. A company will pay a dividend of $1. So looking at this, it says it will pay. So that tells us that this is D1. It has not yet been paid. So that is D1. So you need to get familiar with word problems, and there are several examples on Canvas that you can look at for determining whether or not the dividend stated is D1 or D0. If it has been paid, then it's D0. If it has not yet been paid, then it's D1. Dividends are expected to remain at $1 indefinitely. So that indefinitely, telling us our dividends are staying the same, tells us that our growth rate is 0. And the required return is 12%. Using the Gordon model, because the dividends are growing at a constant rate of nothing, our next dividend is $1. Divide that by our required return minus our growth rate. That gets us $8.33. Okay, But not all the time do dividends grow at a constant rate. So the Gordon model is nice, but sometimes we see a kink in the line. So with the Gordon model, we said dividends are here and they're growing at a constant rate forever. That's not always true. Sometimes we have variable growth rate models. So maybe we have a company that is young and growing. So they're paying a dividend, and that dividend is growing. But here in a few years, when their product line takes off, we're going to expect exponential growth. So all of a sudden, it starts growing at a faster rate. Or maybe we have a company that's in its declining years. So they've been paying a really high dividend, but sales have been pretty flat. But we expect to run out of cash, and our dividends are going to start decreasing. So we see these kinks in the line. Anytime you see a kink in the line, a change in the growth rate, then we're going to have to use the variable growth rate model. This allows our growth rate to change. So it's a 4-step process. I'm going to condense it down. I don't really like the way the book does it. I think that it's easier using our cash flow register rather than calculating multiple present values and adding them up. Your book and I follow some of the same path. So here, the first step according to your book is to find the cash value of dividends at the end of each year. We're going to do the same thing. Step 2, according to the book, is to find the present value of those dividends during the initial growth period, which to me is redundant. If we're already going to have to use our net present value and using our present value functions, why not just do it all in one step? Step 3 says to find the value of the stock at the end of the initial growth period. We're going to do the same thing. And then step 4 says take the present value of that value and then add it up with the present value you calculated before. It seems like a lot of unnecessary steps to me, and so I'm going to condense it down and try to make it more logical than just following a set of rules. Now, of course, if you prefer to do it the way that your text shows, that's perfectly fine. You'll get the same answer. So here's an example. It's easier just to start with an example than to try to go through and list all the rules. Warren Company just paid a dividend of $1.50. We expect the dividend to grow at 10% for 3 years, after which the dividend growth will slow to 5%. The required return is 15%. So they just paid a dividend of $1.50. That just paid tells us that that is D naught. We expect the dividend to grow at 10% for 3 years, after which the dividend growth will slow to 5%. So we're seeing a change in growth rates, and the required return is 15%. So the very first step, step 1, is to put this on a timeline. We know that D naught is $1.50, and so that is not going to appear on our timeline because it has already been paid. So at time period 0, we're wanting to determine the value of this company. We're wanting to know how much is this stock worth today. The problem says that the dividend is going to grow at 10% for 3 years. So that means from time period 0 to time period 1, the growth rate in dividends is 10%. From time period 1 to 2, the growth rate in dividends is 10%. From time period 2 to 3, the growth rate in dividends is 10%. So it has grown 10% for 3 years. After this 3-year growth in dividends, it's going to slow to 5%. So the rule that I have is that we calculate our dividends to one period after where the growth rate becomes constant. The growth rate becomes constant after year 3. It slows to a constant rate of 5%. So we only calculate dividends to time period 4. We don't go beyond that. And you'll see why here in a few minutes. So if our dividend that had just been paid was $1.50, we need to calculate our dividend for time period 1. So we're going to use the formula we used before. D1 is equal to D naught times 1 plus the growth rate. So $1.50 times 1 plus 10%. And here this 10% came from this growth rate of 10%. The dividend grew 10% during that period. And so that gives us $1.65. Now we move to time period 2. The dividend at time period 2 is equal to the dividend at time period 1 times 1 plus the growth rate. The growth rate here is reflective of the growth rate during that period. So at time period 1, the dividend was $1.65. We'll multiply that by 1 plus 10% to get $1.82. Let's do the same thing for time period 3. Time period 2 dividend was $1.82 times 1 plus 10% gives us $2. And now finally we calculate dividend 4. This is the last dividend that we calculate. The rule is that we calculate dividends to one period after where the growth rate becomes constant. The growth rate became constant at the beginning, or at the beginning of year 4. So from between year 3 and year 4, the growth rate became constant. So we calculate dividend 4. So 2 times 1 plus 5%, because this growth rate is indicative of the growth rate during that period. So that's $2.10. So now at this point, we could take the present value of each of these cash flows and add them up, which is essentially what your book asks us to do, which to me sounds silly. Why did we learn how to use our cash flow register and our net present value button if we were just going to calculate the present value of each of these individually and add them up? So we could say the present value of $1.65 at time period 0 is $1.43, and the present value of $1.82 discounted back 2 periods, $1.37, and go through all of these and add them up, and we would get $17.93. But that seems a little bit wasteful. The first thing that we need to realize here is that at time period 3, the growth rate becomes constant. And we have a really nice tool for dealing with constant growth rate dividends. We have the Gordon model. The Gordon model is the model we just used that said that the price today is equal to the next dividend divided by R minus G. So we can make this more applicable. We can use it for any time period if we said that the price today is equal to the next dividend payable divided by R minus G, where that T and that T plus 1 are subscripts denoting time. And so if we use this more generic form, we can say that the price of the stock at time period 3 would be equal to the dividend at time period 4 divided by the required return minus the growth rate. And here this growth rate, that's the constant growth rate. And the constant growth rate here is 5%. So this is the reason why we only calculated dividends to one period after where it became constant, because we were able to employ the Gordon model at that point. So the price at time period 3 is equal to $2.10 divided by the required return of 15% minus the constant growth rate of 5% to give us $21. Now the other thing that I want to tell you is that we only use each dividend once. And so here we just use dividend 4, so we can mark that out. We don't have to look at it ever again. We're done with time period 4 dividend. We've gotten everything brought back to time period 3. So we brought everything back to time period 3, and we don't have to look at time period 4 anymore. If you want a better reason as to why, Remember that the Gordon model is the present value of all future dividends. So once you've used the Gordon model and calculated the present value of all future dividends, you don't have to worry about anything after time period 3 anymore. So now this looks like something we've worked with before. Like, we know how to do this. We could take the present value of $1.65, $1.82, $2, and $21, add them up, and have the value of this stock. Because we're looking at the present value of all future dividends as the value of this stock. If we wanted to do that, you could do them individually and add them up as the book suggests. But that's a bit time consuming, I think. Instead, we could just use the net present value function on our calculator. So if you have a financial calculator, follow along with me first, and then we'll do graphing calculator after. Use your cash flow register. Looking at this timeline, we see that at time period 0, there is nothing for time period 0, so we put in a 0. Push enter and down. We're using our cash flow register here. Cash flow at time period 1. When we look at time period 1, we have a dividend at time period 1. That dividend is $1.65. That is a frequency of 1. Time period 2, we have dividend 2, which is $1.82 with a frequency of 1. Now at time period 3, things are a little bit more interesting. We actually have 2 cash flows at time period 3. We have a dividend and we have the value of the stock at time period 2. So we have to add them together. So we have dividend at time period 3 and the price at time period 3. So it's $2 plus $21 to give us $23. Now we push NPV, put in our discount rate of 15%, enter down and compute, and we should get $17.93. So I'll do it on my calculator here briefly. Okay, I'm going to clear out of here. I'm going to push my cash flow worksheet and then push second clear work. It doesn't clear it out if you don't do that after you've gotten in there. At time period 0, there is nothing, so enter and down. At time period 1, we have a dividend of $1.65. Save that. Scroll down. At time period 2, we have a dividend of $1.82. Save that and scroll down. And at time period 3, we have the dividend at time period 3 and the price at time period 3. So we have 2 plus 21 equals, save that, and scroll down. We then push the net present value button, enter in our discount rate of 15%, and compute, and we get $17.93. If you have a graphing calculator, remember the inputs for your net present value are IY, or your required return, CF0, comma, prices, and your cash flows separated by commas. So it will look like this. Your NPV, 15% for your required return, nothing for time period 0, open braces, $1.65, $1.82, and 2 plus 21. And if you want, you can even put the plus in there. It's okay. Your calculator does the calculation for you, or you could type 23. It doesn't matter. And you too should get $17.93. So let's do another example here. ABC Company will pay a dividend of $1. Dividends will remain at $1 until year 4. Beginning at year 4, dividends will grow at 5%. The required return is 10%. So step 1 is to calculate all dividends until one period after they become constant. So this problem's a little bit easier. It says that dividends are $1 until year 4. 2, 3, 4, 2, 3, 4. So $1 in dividends. And beginning at year 4, dividends are growing at 5%. So dividend 5 would be equal to dividend 4 times 1 plus the growth rate. So it's $1.05. So we only have to go to time period 5 because dividends start growing at a constant rate at time period 4. We could now employ the use of the Gordon model that says the price at time period 4 is equal to the dividend at time period 5 divided by the required return minus the growth rate. The dividend at time period 5 is $1.05. Divide that by 10% minus the constant growth rate of 5%. So using our calculator, $1.05 divided by 5% gets us $21. That's just a fluke. I didn't know that the last one was 21. We also got $21 here and here. That was just a fluke. Now we can ignore everything after time period 4 because we've used dividend 5 already. And the Gordon model says that the price at time period 4 is $21, and that's the present value of all future dividends at that point. So using our cash flow register, we can put in what we know. Cash flow at time period 1 is dividend 1, which is $1. Time period 2 is dividend 2, which is $1. Time period 3 is dividend 3, which is $1. And then at time period 4, we have the dividend at time period 4, and we have the price at time period 4. So that's $1 for the dividend and $21 for the stock price. So $22 is our cash flow at time period 4. So our cash flow register, I open it, then push second clear work. Cash flow at time period 0 is 0. Cash flow at time period 1 is 1. Now I could use the frequencies here. I'm not, only because I don't want anyone to get confused, but if you feel comfortable with it, go ahead. So I'm just typing in what I have written. Our net present value, the discount rate is 10%. And I get $17.51. So the value of this stock is $17.51. If you have a graphing calculator, it would have been put NPV 10, 0, braces 1, 1, 1, 22. You would get $17.51. Okay, let's take a break here for a little bit, and when you come back, the remainder of this lecture will be found on Canvas under the Chapter 7 heading.